Dennis, why don't you just introduce Aisling? We'll go down the road, or down the line, and then we'll come back to some questions.
Sure, we're about as old as you are, except we don't have 180 employees. So, we manage about $1.7 billion in New York, all in the life sciences industry, private equity firm. Our third fund we raised in 2009, and our fourth fund will raise at the end of this year.
So Health Enterprise Partners is somewhat of a corporate or industry-sponsored growth equity fund in healthcare services and IT. We have our fourth fund, 15 hospitals, 7 health plans, Pfizer, and then some financial investors. We focus on healthcare IT and services, predominantly where the customer is either a hospital, a health plan, or pharma.
Malena Dunman, Life Sciences Angel Network. Neither corporate nor traditional, at this point, venture fund. It's a group of professionally managed angel investors. Our focus is medical devices and healthcare IT, and I have to admit that we started with the notion that medical devices will be probably the focus, and then we're going to have some healthcare IT/digital health companies, and it actually turned around. So we're now more invested in digital health than in medical devices. We're based in New York City. We're geographically agnostic. The differentiating factor of the group that we in is the domain expertise. Most of our investors are from life sciences.
And I'm Barbara Dalton with Pfizer, one of the largest pharmaceutical companies in the world with a value of about $250 billion. However, I manage the venture fund, and we invest about $50 million a year. It's a bit of a rounding error for the corporation, but a very important little piece of what we do. So from our perspective, we invest in products, technologies, and services that could be, where Pfizer could be a customer, a collaborator, an acquirer, or a partner going forward. And we try to do that a bit ahead of the corporation because we try to look at where they may be going in the future. We do some blue sky investing. We also do some investing which is right in their wheelhouse too. We try to invest in companies before they get interested in them and bring them to them for partnership purposes. We are location agnostic. We have investments all the way from China to Europe, covering more than half the globe. But there's only 3 of us who operate out of an office here in New York. We've been around for about 10 years. Our portfolio is about 30 companies, and it's quite diverse in that it includes biotechnology companies, device companies, and technology companies in support of a pharmaceutical business too.
Hi, I'm Max Kahn from the Merck Global Health Innovation Fund, also a large global pharmaceutical company. But we actually have a different strategy for our fund than I think what Barbara and the folks do at Pfizer. We're actually there to help Merck move beyond the pill. We actually are not investing to support the core business, but rather to take advantages of the way that healthcare is evolving, and to make sure that Merck is well positioned for that, and as well as looking for ways to potentially expand into new businesses beyond that. So with information really becoming the king within healthcare and driving a lot of the change in healthcare, we're doing a lot of investing in and around digital health technologies, whether that be creating new data through remote monitoring technologies, whether it be just core data infrastructure to help bring the data together, or whether that be solutions that can help different stakeholders to use that information more effectively, understand their populations more effectively, or to provide patients with a way for them to help them manage their disease. We're kind of running the full gambit. We've made about 25 investments over the last 3 years. And ultimately, we're looking to either take advantage by helping Merck understand the space, take a financial benefit from the growth of the companies, or potentially create a new line of business and acquire the companies as well.
Great, thanks. Barbara, I might start with you. In your introduction, you did mention that you also worked for a period of time at SR1 before Pfizer. And if I have my information right, SR1 and perhaps J&J Development Corp. Really some of the foundational pharmaceutical corporate VCs really in existence. In 2010, there were actually 25 corporate VCs in biopharma alone. At the end of 2013, by our count, there's actually 38 of them. So the growth in this space has actually accelerated tremendously, particularly because of the success of biotech starting to get in the game as opposed to traditional. But Barbara, I'd love to get a sense for what you've seen evolve over time with the corporate VC world, and we can begin there.
Sure. J&J is the first pharma company to have entered the corporate venture capital world, but primarily in their device business. And some of their first initial investments were phenomenally successful, phenomenal returns on some of them, and that's what I think keeps you going for a period of time. SR1 entered the business, that's SmithKline's venture capital, was SmithKline's, now GSK's venture capital arm, and they entered the business. J&J started in '79, SR1 started indirect investing in '81, direct investing in '85. And the world was a different place back then. The size of transactions that were done were very small. The rounds actually demonstrated significant value upticks on each round, going forward, and there were public markets in support of the companies on a cyclic basis. But there was a lot of support in the public markets for the early stages of biotechnology. What is different now? Not only the size of what is being done. I think we were rare individuals as corporate venture capitalists back in those days, and we were viewed primarily based upon the behavior that was exhibited, and that was to look, feel, and act like a traditional venture capitalist. So we get invited to the parties, the secret handshakes and things like that, because if you behave too differently, that you're going to be highly suspect. And I think that the pioneers, both at SR1 and in J&J DC, did that quite well, and were accepted to participate in a lot of transactions early on, and treated as traditional VCs. I would say when the bubble occurred, there were not a large number of pharma companies involved. And they were smart in that they came in after the bubble, but I think it was actually because it takes a long time for pharma companies to make decisions. They missed the bubble, and they came in later. But that's probably a better time to come in when the market is down. And so, as you know, more people are participating. And now we're viewed as, from a company perspective, it says, let's go get a strategic investor. So you're sort of put in a different category. Let's go get a strategic investor. I would say in the early days, corporate venture capitalists did not like to co-invest with each other. They felt that they needed to be separate. I believe that is something that's definitely changed. I know that even in our portfolio, we've probably co-invested with most of the major pharmas. We have a couple companies have 3 or 4 pharmaceutical partners involved in those transactions. And this is pure play venture. This is investments in equity, no rights downstream or anything like that. So this is pure play venture when it comes down to it. Corporations use other tools out of their business development organizations to do different things. But when you're talking about pure play venture, the behaviors are very similar to those of traditional venture capitalists. One of the big differences in the last 10 years has been the problems that the private venture capital world has had with the 10-year fund cycle, which has caused them to potentially run out of money, and where the corporate groups do not necessarily, although not all of them are structured the same way, are not necessarily dependent upon the fund cycle, so they potentially have a longer-term view on things. I also think that one thing that has changed, this will be my last point, is that when a lot of corporations got involved in venture capital, they were in it for strategy, for strategic reasons. It was only for strategic reasons. But the reality of it is I think they've learned that they should be in it for financial value as well as strategic reasons. Because there's no reason any corporation should keep around a business that's losing money for a period of time, especially when you're in investment function. So I think that from that perspective, they've become a little bit more focused on the type and quality of investments they're doing, and not just purely a strategy, but it's got to be a good business along lines with strategy too.
And Max,
Can I just ask?
Sure.
You have to speak into the microphones. You try to turn them up, and it doesn't turn up.
For everyone,
Folks
okay.
in the back are having a hard time hearing.
Maybe just pull it out of the...
Barbara, start over.
Perfect. That was
Okay, just come out.
Take them in? Yeah, all right, good. So you just missed it, I'll talk to you later.
And Max, given that you're focusing a little bit more on white space and work, how do you think about potentially partnering up with other corporate VCs? Does that help push you along in diligence? Is it something that you look at with a little bit of skepticism or indifference?
Actually, we're quite favorable towards collaborating with other corporate venture funds. I think especially in the digital space, there's some acknowledgement that being that it's a little bit more, it's a little newer, number one, and number two, that success in those kinds of spaces is going to require a lot of partnering, not just from an investor standpoint, but the companies themselves, right? Most times companies, the best solution is going to involve a number of different capabilities, and a company that is just starting out or is even kind of moving through its phases probably only providing 1 or 2 or 3 of those capabilities, and so they're going to be looking to partner with others. I think that in turn is creating an environment that's very conducive to investors also collaborating. And the other thing that we've started to see is that collaboration is cutting across different sectors, both within healthcare. So we'll see, potentially a pharma like a Merck going with a payer or provider fund, but also bringing in technology investors who are looking into the digital health space quite a bit as well. Qualcomm, Samsung, Google are all very active, just to name 3, are very active venture investors in digital health. And we're seeing a lot of the potential to co-invest with those groups as well.
And Milena, in terms of the angel investing, can you just give us a little bit of an overview for the types of angel investors you're seeing in healthcare, perhaps maybe how that's evolved over time, and maybe how they start to connect with the venture world, and when they start to connect with the venture world?
I evolved from a venture investor to an angel investor. This is a personal story. So basically, Life Sciences Angel Network was started in late 2010. Actually, we started to invest in early 2011. And the reason for that was because the funds for early stage companies were literally not non-existing, but very close to that. There was no early stage funding for life sciences companies that were out there, and everyone was talking about the crisis, about this. No one was talking about bubble back then. It was quite a different problem. And so I actually came from a traditional venture industry, and so trying to figure out how to do well and stay in that industry while loving being a VC, but not being in a fund that is not able to raise money. So I figured out, let me just start the angel group in New York, because I brought that idea from California. It was it's a geographically agnostic group. The main reason I said the main advantage of that group is that we have 50 plus specialties and subspecialties covered within life sciences industry. So that's why probably we're very selective in the number of our investments. We've done 7 investments over the course of last 2.5, 3 years. Our first vintage 2011-12. 4 companies, all of them got funded. All of them had up rounds. One is in acquisition mode, and then we continue to work. So I would say also we'll continue to invest actively. In terms of the space, as I said, we cover both. We don't do drugs. I usually say it's a known line for life sciences angels.
I heard you did drugs.
But we don't do drugs, but we're promiscuous. And that is we co-invest with tech funds, we co-invest with corporate funds, and we co-invest with traditional funds. And so that's probably the reason why, as I said, we had our first batch was funded 100%. We never had any down round, flat round, or a bridge round. So we continue to be that way. So already now have our A's are lined up for the B's, and and so on. So whatever landscape evolving, I don't know. For me, it's something relatively new, and I thought we're going to apply term quality to everything we do, i.e. knowledge and domain expertise. Unless it's very hard to make investments. At least in our world, if you don't know what you're doing, and betting on 40 investments means that you're not you're really betting on them. You really don't know anything about it. It's very hard to have such a broad knowledge about the industry.
One observation, last year in the healthcare field in North America, there's only 45 IPOs for healthcare. 34 of them were actually drug companies. So just a very robust corner of the marketplace.
Finally.
Right? I've been doing this for 20 years. It comes and goes, right? 4 years ago, there were 0. And this year so far, there've already been 11. So it's a market that really ebbs and flows. What I've observed about the marketplace, and Leerink's really a prolific IPO house. And we've found that in this last incarnation of IPOs, the companies have almost had engineered IPOs, where you have wonderful foundational investors. And a quick observation is that from an angel perspective, it's the first time I've seen just a constant in the marketplace where you have very wealthy individuals from healthcare investing back in healthcare and really lending their reputation to deals. And that really catalyzes with angel investors. And then the next level will be looking at who are the leading VCs and what's the diligent work they've done, have corporate VCs come on board to further authenticate the deals. And all of that preparation in the private market engineers an IPO to have an outsized participation in terms of the public funds who jump in and frankly do half the work they used to do because there's so many out there, and they can actually chaperone and have a phone call with a friend, many of whom are on the panel today, to be able to say, that's a deal I want to be a part of. And those deals are being done way outside of the fundamentals, actually, of the deals. And that's actually helping the market get earlier and be even more explosive in the innovation to actually get public dollars. So we see a real connectivity there. I'd love to see, Bob, just your perspective on your LPs, because your LPs are corporate, traditional, and how's that kind of influencing your world as well, more on the healthcare services side of the fence?
Sure. Yeah, it's funny. One of the questions we would get from some of our strategic LPs was around conflicts, and will there be a conflict if we invest in your fund, but then also adopt the services or products of one of your portfolio companies, which sort of gets to this whole question between the what are the corporate investors investing for strategic benefit or financial benefit? And I think they're really investing for both. As Barbara said, these investments have to stand on their own from a financial, investments in funds have to stand on their own from financial performance. But what I would say back to our LPs is, look, the last reason to contract with a company would be because you have a very small indirect investment in the company, because the damage that you can do to your organization by contracting with a subpar vendor far exceeds the benefit that you're going to get from your very, very small participation in the equity of that company. So we're investing out of a $145 million fund, and most of our LPs are $5 million investors. So they have a 3.5% interest in our fund, and let's say we have a 20% interest in a company. So now you're getting down to very, very small fractions of what each LP owns in a given company. It just doesn't make any sense for them to use the excuse of their indirect investment in the company to be the reason that they contract with it. So, but the converse is also true. What we say to a lot of our LPs is, look, to a WellPoint or a Cigna or a Sutter or Cleveland Clinic, if we triple your $5 million investment in our fund, so what? I mean, it doesn't move the needle. You'll never find it in their balance sheet. But the services of some of these companies can have a dramatic impact on their performance. For example, one of our companies last year saved Humana $175 million. Well, they're a $2 million investment in our fund. Well, no way we're going to return $175 million from that $2 million investment, but the company that was in our portfolio saved them that much money. So that's, I think, part of the reason why these strategics have invested in our fund is to, working jointly with them to try to find some of the companies that are transforming the delivery of healthcare and improve their operations. And we actually have many, many examples where our LPs have been transformative in the growth of the companies that we've invested in.
I'm sorry, I'd like the sound, please.
Oh, okay.
I'm sorry. Maybe a little bit louder.
Okay.
Back of the, sorry.
So anyway, that's kind of how we work. That's how we work with our LPs. They're kind of an integral part of our diligence process, and they often become significant customers of our portfolio companies. I can give you more examples as we go on if you're interested.
Dennis, one of the aspects of your background that you didn't cover in your introduction was your work back at H&Q and sort of founding Aisling back in 2000. Well, why don't you walk us through a little bit of what you're seeing different now versus when you formed Aisling, and maybe how the traditional VC model has adapted to the times?
Yeah, I guess it's interesting. It's an independent venture capital firm. I'm the only one on the panel right now, so I guess we're dying.
30% reduction.
Yeah, it's tough. A couple of comments. I'll go to Milena first. There's 9 million people in the United States that never bought, that are accredited, that never bought a private placement. So I think what we're going to see is we're going to see many more individuals, accredited individuals, start to play in this sector. And I think, you know, Melaine is kind of onto something there. I think that Barbara and Max, I mean, I'll pick on Barbara for a second. 10 years ago, not pick on her, I'll praise you. 10 years ago at Pfizer, when Barbara was at SR1, but 10 years ago, it would have never happened if Barbara would have quarterbacked a deal, a company called Celadon that Pfizer really had no interest in. And Barbara thought it was a good deal, and she quarterbacked it and put it together, and the company went public. You wouldn't have seen that 10 years ago. So kudos to you on that one. And I think that one of the things that traditional venture capitalists are worried about is that the pension funds and our investors, unlike, they're not strategics, they're more CalPERS, City of New York, Duke University, etc. They want returns within a kind of 2 to 4 year time frame. And so for us to figure that one out is tough. And people come to us and say, why don't you invest earlier stage? We'd love to invest earlier stage. It's just that we don't have limiteds that have that kind of patience. They have to pay their retirees, they have to pay their benefits, and the way they do it is they invest in people like us, or they invest in real estate or timber or something to get better returns. So I think the industry is changing. I think that there's new sources of capital. I think the corporate VCs here are here to stay, and probably, maybe even, Barbara, I don't know if you agree with this, disintermediate us over the medium term. So the world is changing, and I would forget about the world of doing Series A, then Series B, then Series C. Everything's changed.
Well, if I may add something to it, if you look at the data by National Venture Capital Association from last year, by the end of the year, if you look at the number of the funds, actually the number of the venture funds reduced, but also the differences in the size of the fund. If you look 5 years, if you look at 5 years back, the number now, more than 50% of the venture funds are 50 million and less. So that tells something, and I'm not sure it's necessarily a good trend, but it probably fills two purposes. One, it's because it's incredibly difficult to raise a fund, new one, it's an old underperforming fund, someone trying to restart it into something, you know, put a new phase to something. And the second is, you know, people maybe trying to start slowly, and you know, back to Dennis's point on returns to pension funds, you have more individuals or family offices, or, you know, whatever, who want to diversify their assets, and their return requirements are probably tolerant to A and Bs.
Our last fund was $650 million. So for us to triple that, we have to have over $2 billion of value. So to Melena's point, I think there's a question in limited partners' minds, how big should a fund be? I mean, maybe you guys can take 650 and make it 2 billion, but it ain't the easiest thing in the world. So I think there's a real change in what limited partners think in terms of size of these funds.
I'd like to comment on Dennis's, I'll do a little backslapping and slobbering here, doing one too. The corporate venture capital organizations, at least particularly in the biopharmaceutical space, are very dependent upon the independent venture capital groups, the private venture capital groups. We are all syndicated investors, and we all need each other, and I doubt very much that we will disintermediate the private industry. In fact, I'm lamenting the loss of many co-investors more recently in the last several years too. So I think we're interdependent upon each other, and we need each other to be successful going forward. So I don't want you to go out of business, Dennis.
I was looking for a job.
Going over to Leerink, Dennis. Why do you talk
I don't think so.
Why don't you talk a little bit about what you're seeing in terms of the diligence and the process of investing between maybe the corporate world, the traditional world? You're a bit of a blend here.
Yeah.
You represent that hat and how you're seeing those distinguish themselves.
Right. So our structure is a little bit of a blessing and a curse, and the blessing is we have access to people that have spent their entire careers as experts in the area that this company is probably working in, whatever it is, revenue cycle or some aspect of healthcare IT. And so we're able to access these people who have incredible domain expertise within our LP base. And not only do we not have to pay them for getting that advice, but they pay us a management fee, which is terrific. That's what covers our costs. But so the blessing and the curse is that it would be foolish for us to, send them a capital call for an investment without having first gotten their buy-in. And so it does complicate our diligence process somewhat in that it behooves us to try to get to the experts within a handful of our limited partners and get their buy-in on the company that we think is worthy of investment. And quite frankly, they know a lot more about, they know whether or not they're interested in buying the company's products or services, and oftentimes, if they help us in the diligence process and they're wildly enthusiastic about the company, then they're more likely to become customers down the road, and that benefits us and benefits them. So, from our standpoint, working with the corporate investors in our fund, it gives us incredible domain expertise and really an ability to stack the deck in a way that by the time we invest in the company, we have a pretty good sense of which of our LPs are going to become customers. But it also helps us in another way, which is, if you're a company out seeking money, and one guy shows up with bags of money, and the other guy shows up with bags of money and 10 customers, you're going to take the money from the guy who's bringing the 10 customers along with the bags of money. And so, we're often, in some cases, we're able to invest in companies that really don't need money. But what they do need is access to the C-suites of these large hospital systems and health plans. And over the course of a fairly protracted dating period, we convince them that we in fact have that access. So we actually just signed a term sheet this week with a company that we've been courting for 2 years. We actually invited them to our last 2 annual meetings and introduced them to several of our LPs. And again, they don't need any money. So we convinced them to provide some liquidity to the angel investors and put a little bit of money on the balance sheet. But those are the kinds of deals we like to find because they're already profitable. But it's an interesting dynamic having these strategic LPs. I'll give you one example. They also help us with sourcing. So I guess it was 2001, still goes back a ways, but I got a call from the guy who runs Kaiser's venture fund, and they were looking for a software solution that would be vendor neutral and modality neutral. So they had a CAT scanner from Siemens, and they had an MRI machine from Philips, and they had an ultrasound from Diasonics, and they each had their own little silos of information that had the images that were required on that particular machine. But they wanted software that would interface with all of those vendors and all of those modalities. And they talked to GE, they talked to Siemens, they talked to Philips, and none of them had any interest in interfacing to their competitors. So they found this company that was spun out of the University of Alabama, and it was basically interfacing to all modalities and all vendors. Kaiser did a tremendous amount of diligence on the company, decided that it was a solution that was scalable for their 8 million members, and invested in the company and signed an enterprise-wide software license with the company. And then as one of our LPs called us up and said, we think this is going to change the way hospitals manage their clinical images, and you guys should take a look at it. So we did that, and again, courted the CEO for 2 years, and eventually he came back to me and said, one of your LPs, Ascension Health, which is one of the largest not-for-profits in the country, with about 70+ hospitals, we need a master purchase agreement with Ascension Health. If you can help us get that, all of our existing investors will get out of the way, and you and Ascension can do our Series E, I guess it was, financing round. So we actually had helped Ascension set up their internal venture capital arm. So long story short, 3 of Ascension's hospitals were already customers of the company. That facilitated their diligence. So the time our money goes in, they have their master purchase agreement with Ascension Health, and fast forward 18 months, a third of Ascension's 70 hospitals signed on to the master purchase agreement, which accounted for 25 million of this company's 75 million in revenue. And on the strength of that, we took it public and sold for a 3.8x return in 2.5 years. So the point of that story is, but for our relationship with Kaiser and Ascension, A, we wouldn't have seen the deal. B, we wouldn't have been invited to invest in it, and C, it wouldn't have been as successful. But it's, it's really bringing all 3 of those relationships together was a tremendous advantage.
I think there's a pretty strong presumption from public investors that if a corporate VC is involved, that they probably use their organization to really to really help out in the diligence process, or to at least fact check, or there's some connectivity to the business development side of the world. Max, I'd love to get your view on, again, because you're focused a little bit more on white space, about how you, and maybe also Merck's more traditional in-line, if you will, VC maybe uses the organization. And then maybe Barbara, the same kind of question for you is that a part of marketing? Is it a part of the public investors really not understanding the process, or do you really utilize your internal lieutenants to really get to the bottom of investments?
Yeah, so I think the best way to describe how we use Merck for due diligence is that we leverage them as subject matter experts. It's fairly similar to the way that HEP does it as well, in the sense that we have a lot of experts in a lot of different areas. Even though we're looking at white space, we have a very large healthcare informatics group, that has grew up because of the clinical trials that we run. We have experts on, every single, almost every therapeutic area out there. We have, folks that are experts on our customers, whether they be payers, physicians, or hospitals as well. And so we leverage that group from a subject matter expertise instead of needing to go outside and look for consultants to help us out with that. I think that where we differ because it is white space is that we don't necessarily, though, need a champion from that group as well. So we listen to them. Yes, this technology works, or yes, this is a great idea for that I could see people wanting to use it, but we don't necessarily leverage them in terms of do they have to become a customer, or do they like the business model, or would they be willing to put their own dollars into it? So I think that's where we're able to kind of to be a little bit of a hybrid between the leveraging kind of expertise as a strategic, but without being tied to having it to have a direct business benefit and or a business champion internally.
So we also use the subject matter experts internally for our diligence. However, we do not need a champion in order to say that this is a deal that should be transacted. That decision is left to the venture group and the person we report to at that time. So there's a 2-person sign-off, which is basically me as the lead of the venture group and the person I report directly to. I don't sign off on anything unless the team agrees. So we sort of use the partnership model when it comes down to making investments. But we do use the subject matter experts internally, and our scientists are very good at poking holes in things and telling us what will never happen or what can't be done, too. So that glass half full is really good. That comes from their side. It's up to us to say we're willing to take the risk going forward. Sometimes they're spot on, sometimes it's just outside their bailiwick. We do not have to be 100% aligned. We can go into white space. But we can also ask the experts, once we've made the investment, to help counsel the people if they need some formulation work or something like that. Our internal colleagues, if they're interested under appropriate confidentialities, will provide advice to them. Not tell them exactly what to do, but we'll provide advice. That's very good for us, because if this company then becomes a partner of Pfizer's in the future, they've at least been guided by people, not to say we don't change our mind periodically, but they've at least been guided by people, who are the buyers. I believe that as a corporate investor, one of the things you bring to the table is the customer's perspective in terms of what does the customer need and what the customer is looking for. So yes, it is diligenced. The final decision is not made by, say, the experts internally. But the one area where we never use internal diligence has to do with chemistry, because you can contaminate a chemist's brain, and therefore we always go outside and get outside experts. If we're working in a white space area, there is nobody internally, we go for outside experts in that space too. So.
Let me just add, it's interesting how, it's really interesting to see similarities in approaches for seemingly different corporate or not so corporate structures in investments, right? So we do exactly the same thing. So we have individual members, and we also have corporate members, such as corporations, as part of LSAN. And so when we need to do due diligence on a company, we definitely reach out to them for their expertise. And that expertise actually have two kind of, I would say, two goals. The first goal is, it's not necessarily a pass-fail test, but it's definitely the expertise that Pfizer or Merck or Becton Dickinson of this world has about subject matter is definitely valid. And number two, it's basically making them aware of the company that we're going to invest in, and so it's basically their external R&D, if you will. So it's really very much alike.
I was just going to add, we're a traditional fund structure, and even though we actively solicit the advice of our LPs, ultimately the decision is up to the 4 general partners as to whether or not we invest. So, but it would be, again, if all of our LPs yawn and are not excited about the investment, then we'll probably pass it on to the next one.
For some of the CEOs in the room, and certainly happy to pause for any questions you may have to the panelists.
Do I need a mic, or can I just yell?
Go for it.
We're an association. We're the Association for Corporate Health Risk Management. We're composed of employers that range in size up to 30,000 employees. We're young. We're about 2 years old. We have 4 chapters from DC up through northern New Jersey. All day long, I work with employers to help them in containing healthcare costs. And my question to really I guess the underlying assumption here is we've got a healthcare delivery model that's disaggregating, disintermediating, re-regulating, and some of the assumptions that may have been made when investments are being done today or a few years ago or into the future, I would say in the next 5 to 10 years, Matt, you had made the comment of the payer. The payer is probably going to be the self-insured employer in the future. I don't know how many insurance carriers will still stand in the next 5 to 10 years. The health systems out there are struggling to identify what their new model is going to be. And I'm just curious, with these assumptions and this shifting that is happening, this groundswell that's happening to the self-insured employer becoming the payer in the marketplace, and the knowledge base, and trying to drive for price transparency into the market, I wonder what the decisions are going to be made in terms of what's a good investment, who's going to buy it, and how you're going to change your decisions going forward, because it's going to be a whole different ballgame than it is right now.
Yeah, no, I think that's right, and I would say that the jury's out on whether the employer is necessarily going to be the ultimate payer, because there's also discussion on that employers are going to seed that into the exchanges, which is also a possibility. But regardless, I think that there's a trend that is going to help either way, in the sense that there is, a lot of the companies that we look at are getting better access to more information and using that information to help understand what really works and what really doesn't work, and how you can also influence your employee population. I think in time that could also be a payer's members population to move towards the most cost-effective treatments. So the ability to use data, right, is the foundation for that is being set up to then in turn set up the environment where more effective, where patients can be or members or employees can be, I don't know if nudged is the right word, but nudged into, more effective cost treatment. So I think that will be what helps as those other changes that you described are occurring, and it's not exactly clear how they're all going to settle.
Yikes.
This is the question. The whole question of transparency. I mean, I think that if you look at, most of us at this table, if you ask us about a biotech company or a pharma company, you ask Tony, what's Regeneron doing? He knows it. And what's coming up in Merck's pipeline in phase 3, they know it. This is the future, and the employers are getting screwed by the PBMs.
Yep.
Everybody has their hand out. Nobody. If I wanted to say, give me an overview of the pharma and biotech industry, I can ask Tony, I can ask 99 other people, and that could be a great overview. As it relates to this, just yesterday I had a meeting with 3 pretty senior people in this field. Nobody knows what's going on. Everybody has their hand out. The step-ins, the language is different. The employers are getting screwed, and things are changing. And as it relates to the life sciences industry, I think we have to adapt to, we have to figure out what this new world is, because somebody's going to make money. I mean, as a crass thing, somebody's going to make money. But I was with 3 CEOs yesterday in the same room with big companies, and I asked them to draw me a picture of like the business on the wall. Nobody could do it. So it's the future, and my bet is that transparency is going to rule the day.
I agree.
And if you can figure out a company that figures out how to make things transparent, because right now as an employee, your association, you don't know what the PBMs are paying for those things.
Well,
and you know who the biggest, everybody in the newspaper, everybody complains about the $100,000 a year drug, blah, 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 blah. The real scam is the generics. The PBMs buy generic, the markup on generics is unbelievable, and nobody knows that. Everybody thinks we should go generic, and
go beyond pharma. I mean, every intervention, medical procedure. If I put 10 CFOs here in the room and said, what's the difference in price for an MRI here versus over here? I bet you 90% of them would have no idea.
The difference in New York and a hip replacement is about 10x.
Yes.
If you're in the hospital in New York and you get a aspirin, it's $5.50 $5.50 a tablet usually, and you can buy 100 tablets on Amazon for 99 cents.
So there's a company that is in registration right now to go public that is, essentially is trying to solve this issue, which is a company called Castlight. It's,
they're a step into it.
Well, true, but they're at least step one, and so if we believe the prices at which they're trying to go, that someone in the market is saying that is a very big step, because they're going out with a very small amount of revenue with a very big valuation. Now, we might say that it's maybe a little aggressive, but I do think that the concept that even though their revenue's not that high, they've been tripling every year since they've gotten going.
Oh, yeah.
So, so I do think that is step one, right? And so there are companies that are, and what they do basically, Castlight says if you're going to get a hip replacement, here's the cost of all the providers that will give you a hip replacement in your area. So that, I think that is along the trend that we do see coming. What's going to be added to that is effectiveness eventually. And then I think you can even go a step further beyond that in terms of providing other information in terms of, we've spoken to some people that look at socio-demographic information around an individual, that your outcome may be better if you're someone from the inner city versus from the suburbs versus for a rural town. And when you can start to bring all of that information into one place, right, then hopefully you have an environment where you can begin to get a little bit better control over what's been going on with the cost. So we're not there yet by any means, but at least the market is saying that we do have step one that maybe is providing some value into that whole quagmire.
But there is no way you can funnel all the hip replacements that need to be done in the country to one physician, one hospital.
There's 3 hospitals in Boston within walking distance, inside of a mile, all 3 do heart transplants. Do we need all 3 within a mile of each other in Boston?
Well, perhaps there is a waiting list to get
I mean,
into them
I
as
agree with
well.
you.
Well,
I agree with you.
yeah.
But I think the other thing would be is that, where you have choice like that, I think that my assumption would be is that you will have, patients that normally would have gone to the expensive one because they heard that's the right one to go to are going to end up at the less expensive one, which is in turn going to, which creates, because what we don't have in healthcare right now is true competition, right, in the way that the rest of the world works. Well, if your prices are right there listed against your competitors' prices, right, that's a little bit more like, normal competition, right? So I agree, right, that's obviously not going to occur either, but I do think you're going to see some rationalization of prices as prices become more transparent, as they would in a more normal, business environment.
And we have to think globally, because global, you have the option, you can go to India, you can go to Costa Rica. I mean, these interventions are available everywhere. And once employers, the payers, get more savvy, it's going to take market right out of here, because pricing's going to be wrong, and you got U.S. trained docs in these other areas, and so we gotta
I wonder if more people come to the U.S. for procedures or leave the U.S. for procedures today.
I would say.
I think it's going to come. And you think it's going to change going forward? We're going to leave?
No, I'm just saying we have to look at the full landscape of competition. We can't just say it's the U.S. borders.
Yeah, fair. When you talk about transparency, I think where we really need transparency, I mean, we need it in cost for sure, but where you really need it is in quality. So, you talk about heart transplants. This was several years ago. McKinsey did a study, and there are something like 130 heart transplant centers, and the not-for-profit that allocates people to, or the donors for hearts and where the hearts go and so on. They track the survival rates, and this McKinsey study looked at those 130 centers. And at one extreme, you had hospitals that had a 100% 5-year survival rate. And at the other extreme, you had hospitals that had a 0% 5-year survival rate. And the doctors referring patients to those hospitals that had a 0% 5-year survival rate didn't have a clue. And so
I've got a
the cost matters, but the quality matters a lot more.
Situation. We had a panel of CFOs. In a similar situation, a cardiac procedure out of the Philadelphia marketplace. The difference in cost was 3.5 times. And these are big numbers. It was well over, it was 6 figures. But the performance, the quality, was the lower cost hospital.
Yeah, the lowest cost was hospital.
Certainly a Castlight would have provided an opportunity for that. But there's another side to that, in that, what is this pricing even based on? A lot of it's hocus pocus. So I think we need to get some reference-based pricing put into the marketplace so that we know. We brought an example in out of Tulsa, Oklahoma. This is a surgical center, all-in pricing, facility fee, anesthesia, surgery, flat number. And his number one source of patients was out of Canada to travel to Tulsa. But he's changing the market because now other hospitals are having to step up.
You do see also, I think you are seeing a bit of a trend that that the capitated ACO type of environment is starting to take hold. So it's still early to say for sure that that's going to be the dominant trend in the next 5 to 10 years. But I do think that the data you're seeing, it may not be exactly in the ACO environment, but you're beginning to see provider networks taking on more risk. You're starting to see payers begin to try to become more involved with providers, and so that I think that also is a trend that could potentially help.
You're hitting on something that's really near and dear to my heart. We're having a program in 3 weeks about ACOs. What's the market for the ACO? Right now, the ACOs are self-serving. They service their own employees, but they haven't been able to get outside of that market. So it's stuck in neutral. I think it's a great idea, but we need to we got to bring players together.
Yeah, I think one of the consequences of this exact issue about what's going to happen with the costs, it's paralyzing the investment community. So the investment community is going to certainty. You know, I mentioned before, 45 IPOs, 34 were biotechs. One of them was primary care. 33 of 34 companies were specialty companies focused on these little niches, early enabling technologies, because that's the flight to certainty, because you know if you're going to demonstrably change 10,000 patients' lives, you're going to get reimbursed, you're going to get paid, you're going to have a nice business model that's going to work as an investment, and we are just ignoring the 85% of what is really the bigger problems societally about lack of innovation in some of the biggest areas like cardiovascular, metabolic diseases, CNS diseases, the ticking time bombs that actually are really going to be paralyzing. So the beauty is the IPO market's open, but the problem is it's open up for a sliver that actually can get around that exact issue. Why don't we broaden the conversation a little bit and take a question from the back of the room? Yeah. You can stand up, yeah?
Sure. My question is relatively simple. I come from the services side. We run a company that does essentially operations that provide medical services. My question is, what additional leveraging aspects can VCs from either corporate or traditional VCs can bring to the table, specifically in terms of regulatory issues? So for example, my company tried to open a location in California 4 months ago. We were told that the license would take about a month in order to operate, and licenses are different in the services side. Sometimes they take, sometimes it depends on the county, sometimes it depends on the state. So the licensing process took 4 months, in which we were incurring rent, we were paying employees, and things of this nature. So I'm curious if this is something that a VC or a corporate VC would be able to assist with in terms of leveraging that knowledge from them. Are you able to provide assistance to startup companies that are trying to overcome the regulatory barriers, both in terms of timeline, workflow management, and obviously in terms of being compliant with the regulations?
So I'm not a services person, but if I were in the services business as a corporate venture capitalist and I did the same thing that you did or something similar, I would have internal experts who understood how to maneuver the system. And if you were a member of my portfolio, if you were a portfolio company we had invested in, we would try to get that help and expertise, internal consulting, in terms of helping you move into a marketplace that you have not operated in before, because we've been there and done that. That's it. That's the business that I'm in. I'm not in that business from this perspective. But that's what you'd like to have your corporate investor be able to do. Bring some of their knowledge and expertise to the table. Say, can you help me understand the process for getting up and running in California? And if you're in that same business, you should be able to have experts and knowledge who can help there.
You know, to broaden that, I think one of the things I've definitely seen in terms of company formation, and maybe you want to comment a little bit, Milena, is that the incubator, the sophistication and the breadth of the incubator, you know, whether it's space, whether it's outsourcing expertise, the service providers, they've created an ability to go extremely far in terms of development of a company on a virtual basis, or really leveraging outside consultancies, even in very complex matters. The dollars for the angels, I think, have gone further. The need to just do event-based financing has moved much more towards building a platform and be able to really take it for a long period of time. And perhaps, Melina, you want to just comment a little bit on the company formation side of the ledger.
Well, we're not involved in, we don't call ourselves an incubator, and then honestly, in all honesty, incubator is the last thing I want to do in my life. When we invest, we do invest in companies early on, but we do not form the company. We usually invest in a company, we probably first or second money before traditional VCs or corporate VCs will come in. But when we're looking at the company, one of the criteria of investing at that early stage is A, team, and B, understanding of the problem that you're trying to solve, the market. So most of the time you're betting on the team. And so if the team is not there, the company is not formed, we're not going to invest in it. So I have to tell you, In our portfolio, there are 2 or 3 companies actually that came out of very prestigious incubators, but we didn't invest in them because of that. As a matter of fact, we invested in them because they were great companies, they were great teams, they were addressing real problem that was and real unmet need. And the other part was that we invested in them actually a year later, after they came out of the incubator. Unfortunately, as I said, fortunately, unfortunately, the funding at that stage, at the early stage, is so. There are plenty of opportunities to invest in companies, and so, we actually never funded a company straight out of incubator because I just don't. I don't think they're ready to do that, and they also need to do some team building, and they need to learn how to overcome those. They're entrepreneurs, right?
Let me take a whack at that.
Sure.
I don't pretend to be an expert in this area, but you probably know there are certain states that are certificate of need states and certain states that aren't. And in those states that are certificate of need states, often the incumbents, the existing hospitals and surgery centers and so on, have some influence on the approval of these new expansions. And it is very political, and you be well advised to have a local law firm and one that has deep healthcare regulatory expertise and political connections to help you navigate that.
Just a quick comment on Milena. People are everything. If you look at Regeneron right now, they started out as an ALS company, and now they're one of the 4 best in the. They adapted. They got it right. If you look at Amgen,
Pig growth hormone
was number 7 on their list for the IPO. Look what happened to Amgen. 2 years ago, Mark Przansky from New York, and we love New York, Przansky had $400 in the bank. Today, that's Intercept CEO. Today, Intercept's worth $6 billion. Bet on the people, because it never works, and it always changes. And if you bet on the people, they'll get it right. So, from our standpoint, we go A people and B technology versus B people and A technology every day of the week.
Yeah, I have 2 companies that I invest in and run in early stage med device, and I just wanted to ask the panel about the sort of evolving business models that are being developed really right now in digital health, and in light of all the reimbursement uncertainty and the device tax, how does that affect their investment philosophy?
Should we take a step
Sure,
on it?
yeah.
Okay, now, so how does it take? It's interesting. It's this whole digital healthcare services, etc. For traditional healthcare investors, such as most of us, right? It was and it still is a relatively new area. There are quite a few complicating factors to all that. Is the alignment of interests, several constituencies playing in the healthcare market, etc. But there's also a big, there's a fundamental difference that in healthcare services or healthcare IT companies, the problem that they're solving is a healthcare problem, a real healthcare problem. But the methodology, I would say the business model is coming from tech. And so what I found very helpful is to team with the technical VCs actually on our investments for several reasons. Among all of us, honestly, except for Bob probably, how many, when you heard first time SaaS, PaaS, PM, you were like, huh? What is this? If you've been investing in medical devices, so biotech, etc. And all of a sudden you learn all the terms, and you start to learning that. So this is why it's incredibly helpful to have technology VC as your investor, because they know how to build technology company because ultimately it's probably a technology company addressing healthcare needs and trying to solve healthcare problem in the healthcare space.
As a CEO of a technology company solving a problem in the healthcare space, specifically around behavioral health, I'm just curious, and I know it's going to vary depending on the size of your funds, but how do you think about follow-on investments? Our company's been through several rounds of capital raising. I'm curious, versus in the corporate sector, if you have a $50 million fund, how do you think about contributing additional capital in subsequent rounds versus an independent fund, certainly one with $650 million in capital? I'm just curious if there are differences, and how do you each think about that?
So I don't think you can be a venture capitalist without doing follow-on financing. And just to correct things, I have $50 million a year. Because Pfizer runs on an annual budget, and they're most comfortable with an annual budget as opposed to a fund commitment budget too. That's fine with me. I manage it like a $250 million fund from that perspective. But if you're not there for the next round of financing, you're not a venture capitalist, in my opinion, my own personal opinion.
The world's changed terribly. This used to be a gentlemanly business, and it's not. I mean, Barbara would rip my eyes out if she could. Offerings. So we look at things where you have to take them all the way to the finish line. You know, I would never, I mean, you always have to take money when you can. But boy, if you have the chance to take money that has extra money for follow-on, I'd do that in a heartbeat.
Look at the pay-to-plays, Dennis.
You know,
we never had pay-to-plays. You know,
what happens now is
100
that
to 1 crave your friend.
if Barbara has a company and she's doing a financing and we can't finance because we're out of money or whatever, she crams us down. I have one share of preferred stock now, and she says, I'm going to cram you down to you know, common stock at 1/100th of preferred. So if you can, you got, I mean, it's not the easiest thing in the world, but if you can find people that have some staying power, that's the way to do it, because if not, it's just a disaster. We just closed a round about 2 or 3 weeks ago. I really hate to say this, but it was a Series J. 10 rounds of private financing. Guess how the Series A made out.
We just a little bit of a different take is that when we make an investment, we do look to think about, is this a company that we would potentially acquire, because we are looking for new lines of business for Merck. Now, you know, we've invested in 25 companies. We know we're not going to invest in, you know, we're not going to purchase all 25. So the way that goes over time is that if it's a company that we, you know, as we determine, is this looking like something we might want to acquire, then we actually begin to increase our participation as the rounds go forward. Not necessarily at the expense of the other investors, but well, that's true too. But you know, versus if we decide that we are unlikely to purchase the company, then we kind of revert back to being more of a traditional financial investor, and we'll support the company through the rounds, and you know, we'll look to make sure that we're doing our part. But you know, then it would be a little bit more traditional in terms of like keeping up with everybody else and doing pro rata rounds. So that, you know, we do think about it a little bit differently depending on how we see the company fitting into our longer term goals.
Our strategy's evolved a little bit as we've been doing this for the last 17 years. But you know, we used to do venture and multiple financing rounds, and now we have a much stronger preference for, you know, founder finance companies where we can be the first institutional capital, because the balance sheets are just so much cleaner, and you don't have investors with vastly different time horizons. And so the earlier investors are anxious to get out, whereas the new capital is, you know, wants to see, you know, growth from here. I don't have you beat from the Series J, but I think it was 2003 we did a Series H round investment in a company, and it was kind of remarkable because the prices actually increased from A to H, and often when there's that many financing rounds, it's a sign that there's been some trouble and there's some down rounds in there, but in this case there weren't. But the remarkable thing about that particular company was when we sold the company, I think we had a pretty interesting board, because Humana was an investor and United was an investor, and we had a former CMS director on the board. And twice we reported ourselves to the Department of Justice for potential Medicare fraud violations. When we sold the company, eventually, we were on our third CEO. But I think about 2 or 3 years into it, we had an opportunity to maybe sell the company for 2.5 times what most of the investors had in it. And because we had just come out of one of these investigations and missed our numbers, as the last money in, I didn't have the, I couldn't block it, but I said, this is the worst time to sell a company. We need to get, sell from a position of strength, not weakness. And remarkably, that persuaded the rest of the board, and we sold it 2 years later for 5 times our money. But it's just incredible that we actually had a good outcome from a Series H investment.
Just one observation on this is that for the company formers in the room, I'm constantly amazed by how dilution-focused private CEOs are, particularly when they have a reasonably sizable stake in the company. In terms of not wanting to give up another 5% and taking the best term sheet from a dilution as opposed to a term sheet that's going to be an enduring partnership that actually can attract outsiders on the investment that you just cannot get to on your own. The power of being able to outsource that authentication and expertise and really leverage their experience and their relationships, it's always missed. It's always missed. On the public side, in the busy calendar like it is right now, public investors look at who's investing, who set up the company, do I think the science is working, and actually looking at the management team, and almost nothing has to do with whether the CEO owns 3% or 25% of a company. It has absolutely nothing to do with the conversation for actually making your work get liquid. So think hard about the group around you, and also about some of the other VCs that you're looking to connect to, because they're in hard times, and in the good times, they make the conversation far easier. Yeah, we have time for one more question, please.
I'm a public life science investor. I work at big firms, and the perception is that the sector obviously is doing well, that it's been de-risked, that the FDA is friendlier, that we've had better cash flow, all these metrics. My question to the panel is, are things getting better? Is your deal flow better? Is the quality of deal flow better? If you look at your flow right now versus 5 to 7 years ago, are things very different? Or is it just our perception?
Is the world different than 5 or 7 years ago, given all the positives that have happened in the sector? What's the deal flow look like? I think that's the question, right?
Yes.
Go ahead, Dennis.
I think we're approaching kind of the tail end of the bull market. Tony gave a lot of some statistics, and obviously it's been a great year. Last year, for the first time, we saw big launches that we didn't see before. It used to be short to launch, and last year you should have gone long to launch. You have generalist investors that moved into the sector that are chasing returns. And if you have IPOs that are going up 40% a year, 40% after the IPO price, you got to chase that stuff. So you have that going on. I would say that the quality. We're due for a consolidation. If you look at the big cap biotechs, they're priced for perfection. I mean, Gilead better not mess up, and some of the other ones. Gilead right now is a biotech company, higher market cap than Bristol Myers, higher market cap than AstraZeneca. I mean, I think the real challenge, not as an investor in the sector, but as the sector in the whole, is can we take advantage of everything good going on over the last year and a half, and not have these ups and downs that we've always had, where we've had big bull markets and terrible bear markets, and can we flatten that out a little bit? But I would say from where we are, the really, really good companies got financed at 13. So my hunch is we're on the back end a little bit of the bull market.
We're seeing things get out earlier, probably before they're really responsible to go public, and that's a concern. But it's being enabled by the fact that the fund flows are incredible. The demand for innovation is insatiable. And I think that the fact that the companies on the public side are starting to dip into the private market on the pre-IPO, again, is enabling these even further and earlier to go, because they're almost engineering the exit. Now, I will say that corporate VCs or corporate balance sheets being activated to be a part of deals absolutely changes the conversation.
Like Celgene.
Oh, Celgene enabled about 8 or 9 companies, 13 alone in oncology, and actually even in gene therapy, an area where they're really not involved, by putting in $10 million to $25 million and proactively saying, we want no rights. We want to outsource the innovation. We're keeping an eye on it. In 3 years, we'll think about it. And by the way, the head of BD was available to investors for phone calls. Totally changed the conversation. And I think we're starting to see it actually happen quite a bit more beyond sort of the Gileads and the Celgene. We saw Sanofi do it. We're about to do it actually with Pfizer in a deal in the hospital space. It totally changes the conversation.
I'd like to address the deal flow issue from a venture perspective, which is not the public market perspective. One of the things I really love about this business is entrepreneurs. They're phenomenal in that they pay no attention to what you just all heard the discussion about. They don't even know what's going on in the public markets, et cetera. They have an idea, they want to pursue it, and they're going to try, and they don't go away when the public markets aren't there, et cetera. They keep coming, you know. So when it comes to the deal flow, how it changes now, we may be from a product basis, from a drug, you know, looking more at rare diseases than we ever did in the past. But I will tell you, entrepreneurs aren't paying attention to Tony's business here. They're not looking at what the public markets are. They know that they need to get capital to get their companies going, and they're usually oblivious to what's going on in the financial markets, which is good. We want them to bring forth ideas, even during the tough times, because if all of us went away, all the entrepreneurs went away during bull markets, we would be doing bear markets, we would be missing a whole lot of good companies out there too. So I like the fact that the entrepreneurial engine drives no matter what's happening in the financial markets.
Yeah, and actually the venture business I think is somewhat counter-cyclical, because when the public markets are in the tank, hopefully it reduces valuations and valuation expectations. And so some of the best deals are done in the venture capital and private equity world when valuations are depressed in the public markets.
And just to top all of that, since we're all in life sciences investing, usually deals and opportunities come from the real needs, from addressing real needs. So those needs are not going anywhere. So as far as the quality of deal flow and opportunities, they usually come from trying to solve a specific need. Disease state and efficiency and access to healthcare, et cetera. So those things are not going anywhere.
Well, thank you for holding up your end of the bargain. That would be a very live, interactive panel.